our previous video blog, we discussed how everybody's perception and experience of consumer price inflation is different from that of the average Australian, as measured by the All Group's Consumer Price Index Australia, or CPI, published quarterly by the Australian Bureau of Statistics. We also warned how high levels of inflation could rapidly erode your ability to purchase consumer goods and services. For those currently employed, most will rely on increases in their salaries and wages for inflation protection, although the wages response is currently significantly lagging the recent outbreak of rapid consumer price rises. In this video blog, however, we look at how well, historically, the investment returns of those that are relying solely on their investment wealth to fund their lifestyle have done in protecting against the ravages of inflation. A couple of warnings should be made up front regarding the validity of the analysis. First, broad asset class returns are used to capture investor experience. Investment portfolios that aren't as well diversified may have achieved vastly different results. Second, no allowance is made for tax that may significantly affect how much investors actually received. Tax efficiency is always a critical element of good financial health and is the rationale for the tax effectiveness ratio, one of FinHealth's 5 key financial independence indicators. Third, the interaction of the timing of investment returns and drawdowns from investment wealth to fund lifestyle is ignored. A previous video blog, Cash Flow, Investment Returns and Investment Wealth, discussed this very important issue. And finally, boring but true, past investment returns may not be a guide to future returns. That is, the past isn't guaranteed to repeat. Hi, I'm John Lesky, retired personal financial advisor and founder of FinHealth, a guide to good financial health and your financial independence. As I don't have cost-effective access to long-term financial market returns, the examination of asset class returns is limited to the last 32 years, that is from June 1991 to June 2023, with the data courtesy of Vanguard Australia. However, longer-term data almost certainly tells a similar story. The chart now shown reveals how $1,000 invested in each of the chosen major investment asset classes grew over the period before taxes compared with inflation as measured by the CPI. The performance of an illustrative 40% defensive asset, 60% growth asset portfolio rebalanced annually is also shown. This portfolio comprises 20% cash, 20% Australian bonds, 25% Australian shares, 25% international shares, and 10% Australian listed property. The annualised rate of growth for each asset class, the 40-60 portfolio, and the CPI is also provided. Over the entire period, each asset class and the 40-60 portfolio comfortably outperform inflation, with Australian international shares providing a significant premium. Even cash, that is effectively bank term deposits, provided returns that more than compensated for inflation. The performance of the asset classes relative to inflation are further clarified by examining real or after inflation returns, which adjust actual returns for the eroding effect of inflation. This chart shows the same information as just discussed, but in real or after inflation dollars. It suggests the $1,000 invested into Australian shares in June 1991 would have been able to purchase about 7.5 times more consumer goods and services in 2023 than in 1991. Even $1,000 invested in cash would have been able to buy about 1.8 times more goods and services in 2023. So, at this big picture level, long-term investing in any asset class provided significant inflation protection. However, a closer look at the chart suggests it wasn't plain sailing. For example, there are a number of sharp declines in the real value of the growth asset classes, that is, Australian international shares and Australian listed property, over the period, that were subsequently reversed. Also, the real value of both bonds and cash has been on the decline since June 2020, after growing steadily from 1991. While long-term investments in the asset classes may have historically done a pretty good job in providing inflation protection, they aren't always a short-term panacea. This is demonstrated starkly in the current chart that shows rolling 3-year annualised real returns for the asset classes and the 40-60 portfolio from end June 1994 to end June 2023. It reveals there are a number of rolling 3-year periods where the returns on the growth asset classes and the 40-60 portfolio failed to compensate for inflation. That is, real returns were negative. In particular, Australian listed property was a terrible inflation hedge for the rolling 3-year periods from June 2008 to June 2011. On a 3-year rolling basis, cash hasn't provided inflation protection since 2020 and bonds since 2021. Prior to these dates, they never failed to keep pace with inflation. Even on a 10-year rolling annualised real return basis, as revealed in this chart, inflation protection wasn't a given. While volatility is considerably reduced compared with the rolling 3-year returns, there are extended periods where growth asset classes failed to offset inflation. For example, from the 10 years to 2008 to the 10 years to 2014 for international shares. Cash and bonds' previous reputation for being able to reliably do better than inflation has come under considerable focus over the last couple of years, but the long-term downward trend is very evident in this chart. So, while the past 30 or so years suggest that the growth asset classes in particular can be expected to offer long-term inflation protection, over shorter periods, and even as much as 10 years, they may fail miserably. For example, international shares and Australian listed property for various periods. While Australian shares provided the best protection for the period examined, looking ahead, it's impossible to know what the best performing asset class will be. This suggests that a diversified portfolio of both defensive and growth assets, for example, such as the illustrative 40-60 portfolio used in the discussion, may be a less volatile alternative. With regard to the apparent declining effectiveness of the defensive asset classes, that is, cash and bonds, as inflation protectors, inflation index bonds, either held directly or as a managed fund, may be an alternative worth considering to reduce uncertainty. Commonwealth Government inflation index bonds are guaranteed to give you a return equal to the annual increase in the CPI, plus the market-determined real interest rate. However, this real interest rate varies significantly. The chart shows the movement in the real interest rate on 10-year inflation index bonds from January 2021 to October 2023, illustrating that if held to maturity, you could have locked yourself into a real return varying from as little as negative 0.8% per annum to as much as plus 2.05% per annum. While a negative real return is unpalatable, investors at least know that regardless of what inflation, that is CPI, does, in the future they will be compensated. This may be preferable to being exposed to the minus 8.5% per annum rolling 3-year real returns for bonds achieved for the period to end June 2023. Our conclusions. Well-structured investment portfolios have provided inflation protection for long-term investors in the past, but there have been many short-term hiccups. Looking forward, this remains our expectation, but there are no guarantees. Regardless, you should invest as efficiently and tax effectively as you can to increase the chances of maximising the after-inflation and after-tax returns of your investment portfolio for the risk taken. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. Finally,